You wrote a thought leadership piece once again today, really focusing in on how what we're hearing from Fed Chair Powell now is a focus on jobs. It trains our eyes towards non-farm payrolls on Friday, all the more important, Bill.
Well, he basically said that the goal of the monetary policy is to drive the economy to full employment, to get as many people employed as possible, because that will help low and moderate income households who are less advantaged and less attached to the labor market. He also spent quite a bit of time on his speech on inflation, but basically was reassuring there, arguing that the inflation spike that we have seen is likely to be transitory. And if the Fed were wrong about that, the Federal Reserve would respond as appropriate. So the market reaction was quite positive to his speech. Basically, the Fed is going to let the economy run. Inflation is not going to be a problem in the Fed's view, but the Fed's not ignoring that either.
Yeah, they're not ignoring that, and he basically made that clear. But I think there are still some people, Bill, who are, I guess, maybe just a little, not necessarily uncomfortable, just a little, I guess, reticent here about what sort of gets us to maximum employment. How far do you have to let inflation go to get us there, particularly because we really don't know. I mean, this is basically a new mandate or new communication of what the mandate is. And I guess people are just trying to put some sort of metric there that they can measure. And I'm not sure we know, at least those of us who aren't trained economists, know what that is.
Well, Chairman Powell laid out two things that he thinks are important in driving inflation to be more persistent. Number one, pressures on wages, and two, an increase in inflation expectations. On wages, we haven't really seen any meaningful acceleration, so that doesn't seem to be problematic, and he made that point in his speech on Friday. And on inflation expectations, they've ticked up a little bit. The Fed staff has a measure that summarizes all the different measures of inflation expectations, and it's running at a level very consistent with the Fed's 2% inflation objective. So the chairman tried to be reassuring on that point.
Could you argue, though, that the bond markets are maybe hinting with the 128 on the 10-year, we're back below a 190 on the 30-year, that you have a central bank that may not be as tolerant as we thought of higher inflation, that we won't let it run as hot as we thought?
Well, I think the message of the speech was the fact that he spent so much time focusing on inflation is basically reassuring to the market that the Federal Reserve is looking at this very, very carefully. They're not ignoring it. They're not making a guess that it's going to be okay. They're actually doing the analysis. And so far, their analysis makes them optimistic that the inflation surge that we've seen is going to turn out to be transitory.
Transitory was interesting that we didn't hear quite so much on that turn of phrase, at least, Bill. How much, what inflation data points, how long from your perspective do you now view transitory to be? Is it going to be 2 years of slightly above average? You were saying in your piece it seems to be durable goods that, of course, kicked inflation that much higher. But at what point do we start to see inflation? Because at the moment, the lower income feel it in their food, they feel it in their crop prices, they feel it in their everyday grocery bill.
I think Chairman Powell's view is it's going to start to turn down from these very high levels relatively soon. We made the point in the speech that durable goods prices have actually been falling for most of the last 25 years. So the 7% increase in durable goods prices we've had over the last year is way outside of historical experience. So I think his view is that also talked about base effects. We had big increases in inflation earlier this year. They're going to fall out of the inflation numbers when we get to next spring and summer.
Yeah.
So I think by next summer, we should definitely see lower inflation numbers. If we don't see them, then the Federal Reserve is going to have to change course.
There's an argument to be made, though, that some of the inflationary pressures we're seeing, specifically as it relates to the supply chain and some of those input costs, that there were some structural issues that were kind of playing out even before the pandemic here, with obviously the trade frictions between the U.S. and China and other sort of, I guess, just geopolitical issues. And I'm wondering how much of that factors into where we are today and whether that ends up becoming an issue more so than the base effects that we seem to be focusing on.
Well, if you thought U.S. corporations were going to totally rejigger their international supply chains in response to tensions between the U.S. and China, then obviously that friction would take a long time to work its way out, and inflation could be a lot more persistent. You know, one thing I focus on is where is Apple producing all their iPhones? They're still producing almost all their iPhones in China. So something has not changed that dramatically yet in terms of supply chains, despite all the discussion of that topic.
There are two sort of sticky forces at work. One is sort of the long-term deflationary trends of technology that we've talked about. And on the other hand, we had guests today saying housing prices, wages, once they go up, it's sort of harder to bring those back down. Which of those sort of wins out in that tug of war?
Well, I think wage pressures is really the way the Fed gets a handle on how far they can actually push the unemployment rate down. When they see an acceleration of wages that gets up into the 4% year-over-year rate, then they start to wonder, is that actually consistent with sustainable 2% inflation? Right now, wages are not running at a rate close to a level that would cause you to be worried about an inflation problem, but that's something that they'll definitely be focused on. Last time they were surprised. They pushed the unemployment rate all the way down to 3.5%, well beyond where people thought you could go. And they didn't have a wage inflation problem, and they didn't have a price inflation problem. So we'll see what happens this time.
Bill, of course, as you mentioned in your title, you're now also with Princeton University, and one of your colleagues has been putting forward sort of an article that's created quite a stir over at the symposium over the course of the weekend. Atif Mian, of course, was writing along with some other colleagues from Harvard University and University of Chicago Booth School of Business about how we all thought that the Federal Reserve was in some way helping reinforce inequality. And that's why, of course, we now have this keen-eyed focus on the labor force and ensuring those that have been left behind before now take part. Their thesis is actually that perhaps inequality is forcing the Federal Reserve to keep rates low, that because of the saving rates of the blessed few in the higher income, we're unable to give more ability to cut rates. Is that something that you've seen? Have you read that paper, and what do you make of it?
Yeah, I did read that paper, and I participated in the symposium on Friday. Their point was a very simple one. Is R-star low, the neutral interest rate, low because of demographic trends, or is R-star low because of rising inequality? And they came very strongly on the side that it's low because of rising inequality. Now, the nice thing is, demographic trends are really hard to do anything about, but inequality you can do something about in terms of tax policy. So if the Biden administration is actually successful in raising taxes on the wealthy and using that money to, say, expand infrastructure spending, that actually has implications for a higher neutral real interest rate for the U.S. economy.
All right, we're speaking here with Bill Dudley, former New York Fed president, of course, now senior research scholar at Princeton University Center for Economic Policy Studies. Bill, on that last point, I am curious here as to how the Fed then factors that into their general model here with regards to the fiscal spending here, because there is a lot of concern, some of it genuine, some of it, of course, maybe a little flip about some of the bills being pushed through Congress, and that may add a little bit too much fuel to the fire. And I'm wondering about the timing with regards to the tapering, assuming it starts this year, maybe it ends mid next year, and then at some point you start talking about a liftoff in rates in 2023. Does fiscal policy, fiscal stimulus, economic spending, does it change that timetable?
It could. It could. I mean, I don't think we know yet what's going to actually happen in Congress with 50 Democratic senators. It's going to be tricky to get something passed, let alone the two pieces of legislation that the Biden administration has proposed. The Fed typically just takes the world as it is and doesn't make a lot of forecast about what piece of legislation will or won't be passed. But you're absolutely right. If the Biden administration gets what they want on fiscal policy, both the infrastructure bill and the bigger package, then fiscal policy will be much more stimulative, and that will probably push the Fed to tighten sooner and by more if that goes through.
Let's talk more about the Biden administration. You had a column out on July 29th and highlighting, of course, the fact that the central bank is independent, but there are some politics involved, particularly the reappointments, the renominations of the chair. But the column focuses really on the vice chair, given the role within the banking regulation industry, and to appease the left, and I'm thinking Warren, you could replace Quarles with Brainerd. Why is that a good political move, and should it be political?
Well, I was just proposing that if you wanted to sort of, be Solomon-like and cut the baby in the proper way, you reappoint Powell, which makes the progressives a little bit unhappy, but then you make Lyle Brainerd the replacement for Randy Quarles, and that would make the progressives happy. And so that's sort of a nice compromise. Now, I think, there's a long tradition of reappointing chairmen who have been successful chair. We've had, Bernanke was reappointed, Greenspan was reappointed. People have been reappointed by, even as the party in which power has changed. And so I think there's a good case to be made for Powell's reappointment, especially given that he would have support from both sides of the aisle. I mean, Powell would be confirmed very, very easily. If you propose to replace Powell with someone much more progressive, it's also going to be more problematic getting that confirmations for Congress.
From politics to market functioning, Bill, because that's also the role of the Federal Reserve. And do you feel the market is functioning as you want to see it? Are there any risks bubbling underneath the surface? We look at the reporting on the money market rates, for example, under pressure, the reverse repo rate once again sort of being pulled lower, and indeed perhaps banks having to have a bigger amount that they're able to have in terms of counterparty limit. Do you think that at the moment the money market is under stress, or is it fine?
I think it's doing reasonably well. I mean, I think the big issue that's still outstanding is what is the Fed going to do about the supplementary leverage ratio that basically says that you have to hold so much capital for the assets you hold, regardless of whether the assets are low-risk assets or high-risk assets. And the reason why this is relevant is the Federal Reserve is expanding the amount of assets that banks hold. Every time the Federal Reserve buys a treasury security or a mortgage-backed security, it's adding to reserves in the banking system. It's pushing up the banking system's balance sheet, and that's making the leverage ratio requirement more binding. The Fed has said that they're going to look at this and they're probably going to do something about this, but they haven't done anything about it yet. That's something that the Federal Reserve can fix and should fix going forward.